You found the house and saved the down payment, but because of a 3-digit number, you are forced to slide the keys across the desk. Most Americans use credit cards daily, yet the FICO score, the mathematical model used by lenders to determine your creditworthiness, remains an opaque system to those who rely on it most. Right now, 5 specific habits are likely lowering your score, but each one can be corrected with a specific adjustment to how you manage your accounts. We will rank these mistakes from minor to catastrophic, explain the exact math the bureaus use to penalize you, and provide the specific protocols to reverse the damage. Ignoring this system results in higher interest rates on every loan you take, while understanding the algorithm allows you to access the most favorable lending terms available. Mistake number 5 is opening store credit cards at a retail checkout to save a small percentage on a single purchase. This new credit category makes up 10% of your total score. Every time you apply for a card, it triggers a hard inquiry, a formal check of your credit file, which can deduct up to 5 points from your score immediately. You can avoid this by keeping your credit reports frozen at the major bureaus, which prevents any unauthorized inquiries until you choose to temporarily lift the freeze for a planned application. Mistake number 4 is closing an old, unused credit card because you think it will simplify your financial profile. 15% of your score is based on the length of your credit history. Closing your oldest account instantly reduces the average age of your profile, signaling to the algorithm that you have less experience managing debt. The fix is to keep the account open but inactive. Put a small recurring monthly subscription on the card, set it to autopay, and put the physical card in a secure place where you won't use it for daily spending. These first 2 habits demonstrate that the FICO model does not reward cleaning up your accounts. It rewards a long, stable history of open lines of credit. Mistake number 3 is failing to monitor your credit report under the assumption that the bank's data is always accurate. Accuracy falls under your credit mix and reporting, and currently 1 in 5 Americans has a mistake on their report that is actively lowering their score. You can catch these by spending 5 minutes on the 1st of every month reviewing a free monitoring service to ensure no fraudulent accounts or clerical errors have appeared. Mistake number 2 is maxing out your credit limit, even if you intend to pay the entire balance off by the end of the month. This impacts credit utilization, which is the percentage of your total available credit you are currently using. Banks often take a snapshot of your balance on the statement closing date, not the due date, reporting that high usage to the bureaus and penalizing 30% of your score. To prevent this, pay your balance 3 days before the statement closing date. This ensures the bank reports a low or zero balance to the bureaus before your official bill even arrives. Because the algorithm prioritizes the data it receives at the time of the snapshot, the timing of your payment is just as important as the amount you pay. The most damaging mistake is missing a single minimum payment for more than 30 days. Payment history is the largest factor in the FICO model, accounting for 35% of your total score. While a store card application might cost you 5 points, a single 30-day late mark can cause a sudden drop of over 100 points, removing you from consideration for most competitive loans. This drop can lead to immediate interest rate increases on your other cards and make it impossible to secure new financing for years. You can eliminate the risk of human error by setting up automated minimum payments for every card you own, ensuring the on-time status is never jeopardized. Automation removes the reliance on memory and ensures that the most heavily weighted part of the algorithm consistently works in your favor. When all 5 categories are managed correctly, the credit profile functions as an efficient system rather than a source of financial stress. A credit score is not a reflection of your character. It is a mathematical output that responds to specific inputs. By freezing your reports, keeping old accounts active, monitoring for errors, and timing your payments, you move from reacting to the score to actively controlling it. Mastering these mechanics ensures that when you need to borrow money for a major purchase, you qualify for the lowest interest rates, keeping more of your income for your own use.